but we want to stay on the markets for right now and bring in our next guest, Dan I from Fort Pitt Capital Group, the CIO there. Thank you so much, Dan, for being with us on this very volatile Friday. Just want to get your sense of what's going on in the markets right now. Are we seeing anything of a tapered tantrum? Tech stocks were up on the initial Fed decision, then down, then up, then way down, now less down. And how much of this is also this triple witching phenomenon that happens once every quarter as well, playing on markets today?
Yeah, well, thanks so much for having me. It's nice to be with you. It does look like volatility's back in the near term at least, and I think the trading activity that we've seen over the last few days is really indicative of markets adjusting to the new reality of waning liquidity and the prospects for tighter policy from the Fed going forward. It looks like we are seeing a little bit of relative strength or outperformance from tech and the small caps, which were beat up pretty good yesterday. Maybe that's a small positive sign for us.
Dan, this is Emily here. Going back to your point on tech outperformance today, we're also seeing some moves in the Treasury market, seeing some flattening of the Treasury yield curve. I'm wondering, what do you think the Treasury market is telling us right now as we have that 10-year yield now below 1.4%?
Yeah, I think, looking at long-term or longer-term yields or interest rates, it really is a head scratcher. I think it is, it's indicative of the market expecting that the Fed raising interest rates will slow growth eventually. But it is really hard to square a 10-year Treasury yield below 1.4% when we just saw a headline inflation report at 6.8. I mean, that's a negative 5.5% real yield on a 10-year Treasury. The kind of negative yield I would associate with deflationary, depressionary times or wartime type of periods, not at a period where we're seeing strong equity markets, surging housing prices and corporate profits.
Dan, what do you make of the Fed's decision, telegraphing 8 hikes into 2024? Is that something they can actually pull off, or is it too fast a taper, do you think?
I think that's a great question. I would take the under on that assumption. We just talked about where long-term yields are. If we were to see 8 or 9 interest rate hikes, that puts the Fed funds rate at 2.25. Unless we were to see an aggressive move up in long-term rates, that would invert the yield curve, which has historically been a pretty good warning sign that the Fed has gone too far, too fast. So I think if we look back over the last decade, we've seen that the Fed has pretty aggressively overestimated their ability to hike interest rates. So again, I would take the under on that bet.
Dan, taking a look at the notes that you sent over earlier to us, a couple of the stocks that you highlighted, Apollo Global Management, that is the parent company of Yahoo Finance, as well as Broadcom and Lowe's. What is it about these stocks that you like, and what do you think investors should be focused on with these areas?
Yeah, so first on Apollo, we've seen just incredibly strong inflows into the private equity complex in general. We think that trend continues in a low interest rate environment, and that Apollo will be a significant beneficiary there, given their focus on credit and yield replacement strategies for their investors. Management has set a pretty ambitious goal of doubling assets under management over the next 5 years, but that's right in line with what they've done over the previous 5 years. The stock's done well recently, but it still trades at a very undemanding valuation of about 13.5 times next year's earnings estimates, which is a big, valuation discount to the market and also to, private equity peer groups. On Broadcom, we really like the diversified exposure of their end markets. So, data centers, wireless, cloud, and industrials. Really strong earnings report last week. I think it shows that the business is just firing on all cylinders with strength across all their segments. We saw a double-digit dividend hike, which we've come to expect from Broadcom, given that they generate almost 50%, free cash flow margins. So, looking at their pipeline, the rebound in enterprise spending, and continued strength in cloud, we're expecting another really strong year from Broadcom next year. And then finally on Lowe's, first thing I would say is that we do expect tough comps for Lowe's given very strong years in 2020 and 21. But we are impressed with the progress that they're making on their turnaround initiatives. They're becoming a better retailer. They're operating more efficiently. They've really utilized their labor force more efficiently and build out their online infrastructure. So we think that they're closing the operational performance gap with Home Depot. And we think there's more to go there, but with the stock trading at about a 20% valuation discount to Home Depot, we continue to see an opportunity.
And Dan, I want to turn your attention to central banks. A myriad of them have been weighing in now recently, and they seem to be signaling that Omicron isn't that big of a threat. They're more focused on inflation. Do you think that it is a mistake to discount the potential, at least near-term disruption that this new COVID, whether it's Omicron, whether it's Delta, we don't even know, but this surge in cases that we're seeing in the U.S., because it is disrupting businesses, return to work, restaurants are closing, Broadway's affected.
Yeah, obviously the new variant is here and it's spreading quickly. Now, that's not necessarily new information. I think we firmly expected to see that given the data that we're seeing that we've seen out of South Africa. But I think we continue to hear pretty positive news, from South Africa that there's much lower severity compared to Delta. We saw some headlines and data points out just this morning that hospitalizations are more than 90% lower compared to the similar period of their Delta wave. So, and in the U.S., I think there's very little appetite from the American people for severe restrictions or lockdowns that we dealt with in the spring of last year. So I think the real risk centers around more supply chain disruptions or pressures in areas like China and other parts of Asia that have adopted much different COVID, policies than the U.S.
Well, and Dan, tying in this threat of the Omicron variant with monetary policy and with what Fed Chair Jerome Powell said about the moves towards maximum employment earlier this week, he mentioned we are making rapid progress towards maximum employment. Do you see the Omicron variant potentially throwing a wrench in this move and this recovery?
No, I don't. I think we've dealt with a number of waves already. I think we've established a pretty reliable pattern, if you will, that when we do see case counts rise, it has affected consumer confidence and maybe some consumer spending. But as we hit the peak and those cases fall, we see those things storm right back. So I think I think we're learning to deal with COVID, and we know it's going to be a part of the backdrop going forward, whether it's this variant or the next.
All right, so many more questions for you, but we are out of time. We'll have to leave it there. Dan I, our market guy at Pitt Capital Group, the CIO there. Thank you so much for your time today, and have a great weekend.